हेलो एवरीवन, आप सभी का फिर से एक बार स्वागत है मेरे यूट्यूब चैनल में जिसका नाम है कॉमर्स ट्रेजर। इन दिस वीडियो वी आर गोइंग टू कंटिन्यू आवर डिस्कशन ऑन Q20 सीरीज फॉर अपकमिंग नेट एंड KSET एग्जाम एंड विदाउट वेस्टिंग मच टाइम लेट अस गो टू द नेक्स्ट 20 क्वेश्चंस। फ्रॉम द फॉलोइंग इंफॉर्मेशन फाइंड आउट द नंबर ऑफ यूनिट्स दैट मस्ट बी सोल्ड बाय द फर्म टू अर्न प्रॉफिट ऑफ ₹80,000 per year. Sales price is ₹25 per unit. Variable manufacturing cost is 12 per unit. Variable selling cost is 3 per unit, fixed factory overhead 5 lakh and fixed selling cost is 3 lakh. So we have to find out the desired level of sales in this question. The formula for desired level of sales or desired sales is equal to desired profit plus fixed cost divided by contribution per unit. So contribution per unit is computed by the formula selling price per unit minus variable cost per unit is going to give me contribution per unit. So let us see what is a desired profit in this case. In this case they say desired profit is ₹80,000 per year. So 80,000 is our desired profit plus fixed cost is 5 lakh plus 3 lakh, that is total 8 lakh rupees is a fixed cost, and contribution is nothing but selling price minus variable cost. So selling price is ₹25 per unit minus variable cost is 12 and 3 15 per unit. So contribution per unit is going to be 10 per unit. Therefore 80,000 plus 8 lakh divided by 10, that is 8 lakh 80,000 divided by 10 is going to be 88,000 units. So option number B is going to be the correct answer for this question. Sales of a firm are ₹74 lakh, variable costs are ₹40 lakh, fixed costs are ₹8 lakhs, operating leverage of the firm will be. So operating leverage formula is nothing but operating leverage is equal to contribution divided by EBIT, that is earnings before interest and tax. So contribution is nothing but it is sales minus variable cost, and EBIT is nothing but contribution minus fixed cost. So therefore in this case sales is 74 lakh minus variable cost is 40 lakh divided by contribution is nothing but 74 minus 40, 34 lakhs minus 8 lakh. Therefore 74 minus 40, contribution is going to be 34 lakhs divided by EBIT is going to be 26 lakhs. So 34 divided by 26 is nothing but 2 into 17 and 2 into 13. So therefore we have to find out 13 divided by 17. 13 ones are 13, you remain with 40 point, 13 threes are 39, 39 you remaining 1. Therefore 1.31 will be the answer of this question. Financial leverage is computed by the formula EBIT divided by EBT, that is earnings before tax, and combined leverage is nothing but it is computed by the formula contribution divided by EBT. A, B, C are partners in a firm sharing the profit and losses in the ratio of 4:3:2. They agreed to take D into partnership and gave him 1/8 share. What will be the new profit sharing ratio? Now the formula for new profit sharing ratio is nothing but old ratio minus sacrifice ratio. So sacrifice ratio is going to be 1/8 from everyone. So let us compute the sacrifice ratio. 4 plus 3 7, 7 plus 2 9. So A's share was 4/9, out of which he is giving 1/8 part. 4 into 1s are 4 and 9 into 8s are 72. In the same way B's ratio was 3/9 into 1/8 he is sacrificing. 3 1s are 3 and 9 8s are 72, and C's ratio is 2/9 into 1/8, that is 2 1s are 2 and 9 8s are 72. So therefore let us find out the new ratio. New ratio is going to be old ratio is 4/9 minus sacrifice ratio is 4/72. Therefore LCM is 72. 9 into 8s are 72, so 4 8s are 32 minus 4 is going to be 28/72. In the same way for B, old ratio was 3/9 minus sacrifice ratio is 3/72. Again 72 is the LCM, so 3 into 8, 8 3s are 24 minus 3 is going to be 21/72. For C, the ratio is 2/9 minus 2/72, that is 72 is the LCM. 2 into 8, 16 minus 2 is 14/72. And for D, the ratio is 1/8, and if we have to get denominator as equal 72, we have to multiply this by 9 and 9, so it becomes 9/72. So therefore the ratio is going to be 28:21:14:9. So this is going to be new profit sharing ratio, which is nothing but option number B. If the stock turnover ratio is 6 times, average stock is 8,000, selling price is 25% above cost, what is the amount of gross profit? So stock turnover ratio is nothing but cost of goods sold divided by average stock. So in this case, stock turnover ratio is 6, cost of goods sold we do not know, and average stock is 8,000. Therefore, cost of goods sold is going to be 8,000 into 6. When we cross multiply this, that is 48,000. And they say gross profit we have to compute when selling price is 25% above cost. So 48,000 is the cost into 25%, that is 25 divided by 100. So 1 divided by 4, 4 ones are, 4 12s are. So your profit is nothing but rupees 12,000, which is option number D. When the opening stock is rupees 50,000 and closing stock is rupees 60,000, the cost of goods sold is 2,20,000. Stock turnover ratio will be. So the formula for stock turnover ratio is cost of goods sold divided by average stock. How do you compute average stock? Average stock is nothing but opening stock plus closing stock divided by 2. So opening stock is 50,000, closing stock is 60,000 divided by 2. So 50 plus 60 is 1,10,000. 1,10,000 divided by 2 is going to be 55,000. Cost of goods sold is 2,20,000 divided by 55,000. So 55, 30 gets cancelled. 55 into 1 and 55 into 4. So it is nothing but 4 times. Accounting information given by the company is total asset turnover is 3 times, net profit margin is 10%, total asset is rupees 1 lakh. The net profit is going to be. Now, asset turnover ratio is nothing but sales divided by assets value or total assets. So, asset turnover ratio is 3, sales value we do not know, and total asset is nothing but 1 lakh. Therefore, sales is going to be 1 lakh rupees into 3, that is equal to 3 lakh rupees. Therefore, net margin is 10% of sales. So, 3 lakh into 10% is going to give you rupees 30,000, which is the net profit. Current ratio is 2.5, liquidity ratio is 1.5, working capital is rupees 60,000. What is the current asset? So always remember, current ratio is nothing but current asset divided by current liability. So whenever we say current ratio is 2.5 times, it is nothing but current ratio divided by current liability. So we have to assume that 2.5 is the current asset value and current liability value is going to be 1. Therefore, working capital is nothing but current asset minus current liability, that is 2.5 minus 1, 1.5. So here if you apply 3 rule, when the working capital is 1.5, the value is rupees 60,000. Then when the current asset is 2.5, how much is going to be the value of current asset? So 60,000 into 2.5 divided by 1.5. So 1.5, if you remove the decimal points, 5 3s are 5, 5s are 3 1s are 3 2s are. So 20,000 into 5 is going to be rupees 1 lakh, which is the value of current asset. If the opening stock is rupees 10,000, purchases rupees 70,000, wages rupees 2,500 and carriage inward rupees 500, closing stock rupees 15,000, what is the manufacturing cost? The formula for manufacturing cost is nothing but opening stock plus purchase value plus wages plus carriage inward minus closing stock. So let us see, opening stock is 10,000 plus purchases is 70,000. So 10 plus 70, 80,000. 80,000 plus 2,500, 82,500 plus 500 is going to be 83,000 minus closing stock is 15,000. So 83 minus 15 is going to be 68,000 rupees, which is the answer for manufacturing cost. X and Y are sharing the profit in the ratio of 4:3. Z joined the firm and the new ratio among X, Y and Z is 7:4:3. The sacrifice ratio between X and Y will be. Sacrifice ratio is nothing but whatever is the old ratio minus new ratio. This is going to give me an answer for sacrifice ratio. So old ratio of X, let us find out. Old ratio was 4:3, that is 4 by 7, 4 plus 3 7. 4 by 7 was the old ratio minus new ratio is 7 plus 4 11, 11 plus 3 14. So 7 by 14 is the new ratio. So LCM is going to be 14, 7 into 2. So 8 minus 7 is going to be 1 by 14. And Y's sacrifice ratio is old ratio of Y was 3 by 7 minus new ratio is 4 by 14. So again LCM is 14, 7 into 2, 3 2s are 6 minus 4 is 2, 2/14. So sacrifice ratio of X and Y is nothing but 1:2, which is option number D. X Limited forfeited 500 shares of rupees 100 each, fully called up for the non-payment of allotment money of rupees 30 per share and call money of 40 per share. All these shares were reissued at rupees 75 per share as fully paid shares. The amount, if any, that X Limited should transfer to capital reserves is. So the company has 500 shares which it has forfeited, and it has already collected out of 100. 40 and 30 are still not collected, so 40 plus 30 is 70. Out of 100, 70 is not collected. It means that 30 rupees you have already collected. So 500 into 30, 15,000 rupees you have already collected. Now you are reissuing the share at 75 rupees per share. So the value of the share was rupees 100. It has been reissued at discount. So the loss in this case is rupees 25. 100 rupees share, if you are selling at 75, 100 minus 75, 25 rupees is going to be lost. So 500 into 25, 25 into 5, 125. So 12,500. So 15,000 you have collected, out of which 12,500 you are giving discount. So remaining value, that is 2,500, is going to be transferred to capital reserve. Next is match the following type of question. 3 types of leaders have been given and the features of those leaders have been given. Autocratic leader makes announcement and decisions, seeks idea before decide with the group on one-to-one basis. So autocratic leader is a leader who makes and announces the decision. He does not ask any of his team leader, just announces whatever he feels like. Participative leader is one who decides within the group on one-to-one basis. So he asks in the group on one-to-one basis and then he gives his suggestion or decisions. And democratic leader is one who seeks idea before making decisions. He asks all his teammates or followers and then he takes the decision. So A1 we have 2 options, B3 we have only 1 option, that is option number B. In line and staff form, the function of staff is obey the line, serve the line, inform the line, advise the line. So always remember, in line and staff organization, the function of the staff is to advise the line and not to give any commands. Line manager work is to give commands. Line manager includes marketing manager, finance manager, etc. Staff managers includes personnel manager, quality manager, etc. So line and staff is a very important type of business organization structure. Apart from this, we have matrix form of organization, functional form of organization, and line form of organization, which is oldest and the simplest form of organization structure. Which one of the following is not a measure of dispersion? Skewness, mean deviation, standard deviation, quartile deviation. So skewness is not a measure of dispersion. We have 2 types of measures of dispersion. One is called as absolute measure of dispersion, which includes range, caudal deviation, mean deviation, standard deviation, and variance. And second is relative measure of dispersion, which includes coefficient of range, coefficient of caudal deviation, coefficient of mean deviation, coefficient of standard deviation, and coefficient of variation. Skewness is nothing but whenever the mean, median and mode is not equal in a distribution, then it is called as a skewed or asymmetric distribution, which is also called as skewness. Dash is a process of deciding how the company fill the most important executive position. Succession planning, organizational reconstructing, self-directed teams, corporate downsizing. So the correct answer is option number A, succession planning. Succession planning is nothing but it is a process wherein you think about future, that who is going to take the important positions of the company after retirement of the key persons of the company. For example, in a company, the position of the chairman or board of directors, who is going to be the next chairman or next director once the person who is the present directors resigns or comes down from that particular position. Which among the following is not a category of non-performing assets? So non-performing assets, commonly called as NPA, are nothing but if the borrower fails to make payment of principal or interest for 90 days, then the loan is considered as a non-performing asset. So standard asset is a type of NPA, doubtful debts is a type of NPA, loss asset is also a type of NPA, devaluated asset is not a type of NPA. So option number D is the correct answer, which is not a type of non-performing asset. Standard assets or substandard assets are those for which principal or interest has not been paid for less than 12 months or 1 year. Doubtful assets are those for which principal amount or the interest has not been paid for more than 12 months, and loss assets are those on which the principal or the interest is not going to be recovered, and therefore it is treated as loss to the bank. Sale of Goods Act 1930 is related to all type of movable property, immovable property, both A and B, neither A or B. So correct answer is option number A, movable property. So Sales of Goods Act 1930 is related only to movable property, and for immovable property like land, we have an act called as Transfer of Property Act 1882. I have made a detailed video on Sales of Goods Act in which I have discussed about various topics on Sales of Goods Act. If you have not seen that video, I am putting the link in the description as well as in the I button. Which of the following is not treated as goods under section 2 subsection 7 of Sale of Goods Act? Stock and shares, growing crops, water and gas, actionable claims. So Sale of Goods Act defines all movable goods under the definition of goods, which includes shares and stocks, growing crops, water and gas, but it does not include actionable claims. So correct answer is actionable claims. Actionable claims are nothing but these are the unsecured debts. For example, if you have given loan to your friend and he gives you a promissory note to keep, then that is called as actionable claim. In Sale of Goods Act, all the movable properties are taken into consideration except actionable claims and money, but old money, that is old currency or old coins, can be treated as goods under Sales of Goods Act, but the present currency cannot be treated as goods under Sale of Goods Act. The act which aims to promote transparency in government institution in India is Information Technology Act? No. Right to Information Act 2005? Yes. So Right to Information Act or RTI Act of 2005 has been brought in order to promote the transparency in government institutions in India. If you have to find out any information, you can make use of this RTI Act and get the information from the institutions. The maximum amount of capital that company can collect in its lifetime is authorized capital, issued capital, subscribed capital, paid up capital. So the maximum amount, whenever they say, it is nothing but it is called as authorized capital. It is also called as nominal capital or registered capital. Issued capital is nothing but it is a part of authorized capital which has been issued by the company for public to subscribe. Subscribed capital is nothing but whatever amount of shares public has subscribed, then it is called as subscribed capital, and on subscribed capital whatever amount has been paid by the public is called as paid up capital. I have made again a video on different types of share capitals with examples. If you have not seen that, you can just go to the playlist and find out that video. I have explained about authorized capital, issued capital, subscribed capital, called up capital, uncalled capital, paid up capital, unpaid capital, calls in arrears, etc. Share premium account balance can be used for issuing full paid bonus shares. Definitely yes. Writing off preliminary expenses, correct. Writing off discount on shares and debentures, correct. So all of the above are the purposes of using share premium balance. Apart from this, you can also use share premium account balance to pay for the redemption of redeemable preference shares and debentures. So this is all about today's video. All the best for your exam, and if you haven't subscribed my channel yet, please subscribe my channel and also press the bell icon so that you can get a notification as soon as I upload a new video. Thank you for watching this video and share this video with your friends.